Okay, let's move on to operating activity section. Now remember we talked about the statement of cash flows. We said three main areas, which are what? It's called operating, investing, and financing. Then we have our net change and so on. The thing is, there are two ways to do the operating activity section. So when we talked about net cash provided by operating activities, we ended up with this number here, which was $135. But there's two different ways to get there. One is the direct cash approach, like how much cash directly came in, directly went out, directly came in, directly came out. That's called the direct method. The other method is called the indirect, where you start at the bottom line number of the income statement, which is what? Net income. You take net income and you indirectly reconcile back to how much of that is actually cash. Because realize, just because it's on the income statement doesn't mean it was actually cash in or cash out. For example, depreciation expense is not debit expense credit cash. It's debit expense credit accumulated depreciation, which doesn't hit the income, which does not affect cash. Equity and earnings from investments under the equity method. When they make money, I record it as a debit investment, credit equity and earnings. That's an income statement account, but it's not cash. So in the cash method, direct cash, that says take every line item on your income statement, convert from accrual back to cash, accrual back to cash. The indirect says forget that, start at the bottom line and take net income and then reconcile back to how much of that was actually cash. So with the operating activity section, again, there's two methods. One is called direct, called the direct cash approach. You'll see in your notes, direct cash approach, the preferred method. It says sales are adjusted for changes in receivables. Costs of goods sold are adjusted for changes in inventory and payables. Selling expenses adjusted, interest expense, income tax expense, and so on. It says note 1, gains and losses from sale investments and expenses not requiring the use of cash are not reported, like depreciation and amortization. If selling expenses includes depreciation or bad debt, then they should be deducted since they do not involve the payment of cash. So that's what they're saying. The indirect method is the indirect, you're indirectly reconciling back. So as we go through this, here's your GAAP income statement. And you've got all your items, sales, boom, cost of goods sold, boom, SG&A, boom, and so on. You get all the way down to what? Net income. So the direct method says take every item, directly convert from accrual to cash, accrual to cash, accrual to cash, and so on. Indirect says forget that, take net income and indirectly reconcile back to how much should have been the cash. All right, so if you look in your notes, indirect method, reconciliation, income from continuing operations is reconciled to cash, net cash flow from operating activities by adjusting for differences related to things like receivables, inventory, payables, non-cash items like depreciation, amortization. So let's think about it. If you had depreciation expense here, for the direct method, ignore it because it's not cash. For the indirect, it's already backed out. Don't I still have that money? So add it back. So those are the kinds of adjustments we have to do. All right, so let's start out by setting up these numbers in the financial statements, and I'll kind of show you the approach that we use in order to get through this. So starting out, we have the Roger Company, and this is what? This is your income statement. This is under what method? Accrual. So what we're going to do is basically take this and go from what? Accrual back to cash. Accrual back to cash. La 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 la. Sounds great. All right, so let's clean this up. And we will set this up. Okay, so let's start out here with my Roger Co. income statement. I've got sales of 600. I've got costs of goods sold of 200. I have selling expense of 100, and it mentions there it includes bad debt of 20. I have G&A expense, which is 40. Depreciation expense, 50. Interest expense, 30. Equity and earnings. And equity and earnings is what? That's an income statement account of investee for 10. That is under the equity method. Income tax expense. Good thing you've got it in your notes. Income tax expense, which is 60, and gain on sale of available for sale securities is 10. That gives me net income of 140. All right, so I've got sales, cost of goods sold, selling expense, G&A, depreciation, interest, equity and earnings, income tax expense, gain on sale, and net income. Now, under the direct method, you take every item and directly convert from accrual to cash, accrual to cash, accrual to cash, because this is my income statement. Under the indirect method, you start with 140 and you indirectly reconcile back by adjusting things that were not cash or not expenses and so on. So that's what we're going to do as far as adjusting it.